investor allocation. So while the markets did 8 to 10% annualized over a 20-year period, the average investor only did about 2 to 3%. And the biggest reason we think is market timing. Many investors are not invested through a cycle. They get shaken off. It may be, maybe Trump saying something, or maybe fears of a North Korean war. And I think that leads to persistent underperformance. And this is quite dramatic. Amit Chandra, our analyst and portfolio manager, came up with this, where we analyzed if you had invested in the markets in 1925, and this was, I think, $100, if you had not timed the market, that would have grown to $660,000. But the yellow line is if you had missed one best month every 5 years, all you had to miss is one best month, your performance dropped. So instead of growing to 660,000, you had 174. And if you missed one best month every 10 years, you sort of dramatically outperform. So this goes to show that market timing is something, it's not a consistent strategy. It is not something which you can bank on. You need to get two decisions right, when to get out, when to get back in. So our feeling is, with our experience, we think rebalancing makes sense, going from areas of overvaluation to areas of undervaluation. And this we call the price of admission. And if you look at stocks over time, if you take a look at the US and look across, the average rate of return since 1926 in US markets were 12%. So this has been a phenomenal wealth creation engine in our economy. That means every 6 years you doubled your money. Every 12 years you quadruple your money. And you can sort of mathematically see how dramatic that was. Over the past 10 years, and that includes the crash of 2008, we are down to 7.7. But as you can see on the right-hand side, there's something called standard deviation, and that's really the price of admission for stocks. If you have to be in stocks, you have to be willing to undergo the ups and downs of 20%, and certainly it's much higher for other markets like emerging markets or sectors like markets like Germany or France. And this is another favorite chart of mine. Oftentimes the argument made is markets are going up because the Fed is lowering rates. So markets are going up because Trump is coming out with tax cuts. And that might be true on the margin. But our sense is 90% of the time, the markets go up or down over the long term based on earnings or profits growth and based on the level of interest rates. So after all, interest rates sort of control, give you an idea of the net present value of a series of cash flows. So interest rates are important. Rates are 2%, that means your NPV is much better as opposed to being 10%. So this is quite dramatic. Since 1987, we've had a dramatic increase in earnings. As you can see on the left, on the y-axis are the S&P earnings, which went from $20 a share to almost $140 a share. And you can see what the S&P has done. It has kept in lockstep with earnings growth. So if you don't have earnings in an economy, and that's why you find typically China for many years, for example, had great sales growth, but didn't have profits growth. So their markets did not do well. So markets which tend to do well are those markets which are shareholder friendly, which where earnings are also going up. And this is another interesting chart. Oftentimes people look at PE ratios in isolation. So PE ratio has two levels. It's got the P, or the price, and you've got earnings. So P goes up and E doesn't go up, you're in trouble. That means the market's sort of getting overvalued. But in a case where your earnings growth and price goes along with it, you're in pretty good shape. So we spoke about the discount rate. And this looks like the Killington ski slope. 1981, you're at 15.84% in the 10-year bond. And today you are a little under 2.4%. So you made money in bonds regardless of what bond you bought. We think that trend may be changing, but maybe changing slowly. But that interest rate has an impact on the PE ratio. And perhaps Chuck later on and Chris can talk a little bit more about the impact of interest rates on PE ratios and what should be the appropriate PE ratio at this point in time of the cycle. So with that, I want to introduce our panelists.